In the world of crypto, if you're not moving forward, you're basically moving backward. It's just that fast. So what happens when a blockchain's core tech just gets old? Today, we're going to dig into how capital flees those aging protocols and how that whole migration completely reshapes the economic landscape. And this quote right here, it gets to the absolute heart of it. In crypto, tech isn't just a nice-to-have feature, it's a massive magnet for capital. The second that innovation starts to stall, believe me, the money does not wait around. And let's break down exactly how that works.
All right, so why does the money move? We're not talking about a slow leak here. We're talking about a huge shift, what you could call the great capital migration. And to really get it, we've got to start at the root of the problem.
Well, it all comes down to this idea of protocol obsolescence. And put simply, this is just when a blockchain can't keep up anymore. Its tech, its speed, its security, the tools it gives developers, it just doesn't meet what the market needs right now. It's become a dinosaur.
So what does that aging tech actually look like? Well, it's usually a mix of things. You've got sluggish transaction speeds, outdated security models, and maybe worst of all, clunky tools that make developers want to pull their hair out. Any one of these can be the first crack in the foundation, and that's when you start seeing the economic problems bubble up.
Yeah, in those technical cracks, they don't stay hidden under the hood for long. They create very real, very clear economic warning signs. Red flags that you can actually see and measure on-chain. Okay, so there are three big symptoms to watch for. First up is liquidity fragmentation. Basically, market makers start to pull out, which makes it way harder and more expensive to trade. Second, the cost of capital goes up. Funding for new projects just dries up, forcing them to pack up and move to a more promising chain. And third, you see valuation compression. The protocol's fee revenue just tanks, and its market cap shrinks right along with it.
And here's the kicker. These things don't happen in isolation. They all feed into this really dangerous negative feedback loop. Think about it. Liquidity gets worse, so users leave. Fewer users means less fee revenue. Less revenue makes staking less attractive, which then weakens security. It's this vicious cycle that just eats away at a chain's value once that initial tech advantage is gone.
And this brings us to this really powerful idea called reflexivity. See, these market dynamics create a brutal downward spiral for the laggards, but at the exact same time, they create a compounding upward spiral for the winners. It's really a tale of two completely different futures. And this comparison just lays it out perfectly. Look at the winners. They're pulling in capital, capturing more fees, and just seeing a flood of new apps being built. Meanwhile, the laggards are bleeding capital, they're losing their funding, and their development slows to a crawl, which just torpedoes their entire story in the market. So what's the actual tipping point? Well, developers are practical people. They will always chase better performance and faster transactions. Applications are going to move to wherever block space is cheaper. And the users? They just follow the money and the action. And this is the crazy part. Those powerful network effects that built up the old chain, they actually reverse and start working for the new leader instead.
So if you're an investor, how do you spot this whole decline before it's too late? Okay, this is the really practical part of our explainer. Let's actually build a dashboard of the key early warning signs that you need to be tracking.
All right, let's build our dashboard. We need 4 key metrics. First, fee revenue and MEV. This is the total cash generated by the chain. You have to ask, are apps actually making real money here? Second, bridge flows. This tracks the movement of capital. Is more money consistently leaving the chain than coming in? Third, developer metrics. Look at the code commits, look at tool adoption. Is anyone still building here? And finally, validator health. Are the stakers, the people securing the network, still earning a healthy, real yield?
Now, beyond the raw numbers, there are these other, let's call them qualitative factors that can act like a protective wall. You want to see high developer retention and transparent governance. But honestly, the most crucial question is this. Is the team actually shipping meaningful upgrades, or are they just selling you promises on a roadmap? Because in this space, execution is absolutely everything.
So all of this leads to a pretty unavoidable conclusion. In the world of Layer 1 blockchains, it is truly survival of the fittest. Let's just boil this all down to the final takeaway.
Please remember this. When a protocol becomes obsolete, it is not just some technical footnote in its history. It's a fundamental economic regime shift. The market is constantly reevaluating innovation, and you have to understand, capital is cold. It chases utility, and it has zero time for nostalgia.
And this quote from our source material, it just says it all, doesn't it? The moment a protocol stops pushing forward, The second it stops evolving, you have to assume the market has already moved on. It's already looking for the next big thing.
So we're going to leave you with a question to really chew on. Take a good hard look at the projects you follow, maybe the ones you've invested in. Which ones are actually evolving? And which ones might already be on their way to becoming museum pieces? The answer could make all the difference.